Robinhood continues to be one of the most innovative companies in the brokerage industry right now, and their CEO, Vlad recently said that he thinks 24-hour trading, and he called it 24 by 5, so 5-day per week, 24-hour trading is coming to the stock market. Doesn't see any reason why that isn't going to be the case. This is something that we've had in crypto basically since the advent of cryptocurrencies, but hasn't been the case in the stock market, where market hours are different in the US than they are in Europe, than they are in Asia. It's kind of all over the map. So I want to go through exactly what he said and what the driving force might be for Robinhood, how this could actually benefit the company and its business model. My name is Travis Hoium. Thanks for watching Asymmetric Investing. Please subscribe here on YouTube for all my content. And thanks to this video sponsor, The Motley Fool. If you go to fool.com/ASYM, they'll give you their top 10 stocks to buy right now. Now, the direct quote from Vlad about 24-hour trading is the following: "It's for sure going to happen. It's just a matter of time." This was on the Logan Bartlett podcast, and he talked about some of the incentives and what the reason for going to 24-hour trading is. One of the biggest ones that he talked about is the pop or drop that often happens with stocks at the start of trading. And the argument is that's because there's imperfect liquidity in the market. So if you had 24-hour trading, you would actually just be able to adjust prices on a moment-to-moment or second-to-second basis. To answer this, Robinhood has actually introduced 24-hour trading for 900 stocks of its own. You can see that here on the Robinhood site. 24-hour market is available Sunday 8 p.m. Eastern time through Friday 8 p.m. Eastern time. So that's that 24 by 5 that I mentioned earlier. Now what they use is Blue Ocean Technologies. What is Blue Ocean Technologies? It is a fintech company that focuses on providing after-hours trading and data solutions. Basically, they are providing the liquidity to Robinhood and to allow this trading. Robinhood doesn't want to take these risks themselves, so they're going to work with partners like this to provide liquidity. Now, they do have price bands of about 20%, so that means that prices aren't going to move above 20%, moving up 20% or down 20%, and periodically they are going to limit trading as well. But the idea here is to bring liquidity to the markets. And this is where the competitive dynamics of the stock brokerage business and the exchange business is, I think, going to be really impacted by these kinds of moves. If Robinhood is able to offer this kind of liquidity to customers on its brokerage platform, well, other brokerages are going to have to offer the same kind of liquidity and hours of operation. That's the way the competition works, especially in brokerages. And this is really where Robinhood broke into the industry. I remember they were really the first company to go to $0 trading fees. A lot of brokerages, when the pandemic hit, were still at that $5 to $7 range per trade. Robinhood said, hey, we're going to be a free trading platform. That brought a lot of active traders to Robinhood. How can they do that? The reason that they can is that they are getting paid for what they call order flow. And this is what that is according to Bloomberg law. Payment for order flow is a long-time market practice under which market makers or wholesalers pay retail brokers for the opportunity to fulfill customers' orders. For example, about 75% of Robinhood's nearly $1 billion in revenue in 2020 came from payment for order flow. So why would somebody want to pay for order flow? Well, these market makers are literally making a market in stocks. So typically what that is going to do, it's going to manifest in that bid-ask spread. You can sell a stock for one price, you can buy a stock for a slightly higher price. And that gap between those two numbers is where the market maker is going to make money. Payment for order flow is going to basically allow the company paying for that order flow to take both sides of that trade and maybe adjust their pricing depending on whether there's a lot of activity, whether that's in options or in stock prices. So that's really the way that it works. On a second-to-second basis, it's going to make being something like a day trader much less efficient. If you don't have some of those market advantages working to your advantage, someone is essentially going to have to pay for these transactions, and this is one way to do that. So as an individual trader, if you are using Robinhood, which is a platform that I use, you don't have to pay to use the platform, but you may get a slightly less attractive transaction price by a penny or two because of that. Now, for me, I'm buying stocks and holding them for years, so that is less impactful to me than paying the $7 to $25, which I have paid over the course of the last 3 decades or so to buy or sell stocks. So that's really the way that it works. And it's going to be the same thing in 24-hour trading. If there's trading that's happening, there is going to be somebody making a market and making money on making that market. Now, the bid-ask spread will likely be bigger, which it typically is with pre-market trading and with after-hours trading, where that spread may go from a penny to a nickel or a dime. We're going to see the exact same thing with trading after hours, with trading off hours or 24-hour trading. So don't expect to get the best price if you want to sell the stock at midnight in the US. But what Vlad is arguing is that you should at least have the ability to sell that stock at that time. Now, Robinhood, because of that payment for order flow, has an incentive to make this work and increase the amount of volume that is going through the system because that's where they generate their revenue. But that's really the thinking behind it. Thanks to our friends at The Motley Fool for sponsoring this video. Visit fool.com/ASYM for the top 10 stocks to buy right now. So is this going to be a game changer for Robinhood? Probably won't be a game changer, but what they're looking for is, can they continue to attract assets to the platform? What brokerages are going to do is going to make money in a number of different ways from their businesses. I've talked a lot about payment for order flow here, but they're also going to make money on margin loans. Robinhood has their gold subscription, so they're going to make money on that. Anything that they can do to attract assets to the platform. The other thing would be shorting fees. Brokers and investors get paid to allow other people to short stocks, especially depending on what the short interest is in that stock. So there's a number of different ways that brokerages can make money, and having more assets on the platform is going to be a much more attractive business model. We have seen that over the last year or so with Robinhood. The company's revenue has really grown significantly as it's been able to attract more and more assets. I think that will continue. It did in the first quarter. I think that will continue in the second quarter. Got nearly $5 billion in assets added during the month of April. As I'm recording, we don't have the data from May yet, but it looks like there's a lot of momentum in the business. And all of these things are going to work to increase revenue, increase profitability for Robinhood. We saw that with the company really making its name with $0 trading during the pandemic. Everyone had to follow suit. But Robinhood was fundamentally built to do that because they don't have the same operating costs as a lot of their brokerage competitors. We're going to see the same thing with 24-hour trading. Why not have 24-hour trading if you have market makers available, if you're getting paid for order flow, if you have a digital platform that doesn't require somebody to physically be in an office? You can just run that system 24 hours a day instead of running it a few hours a day, 5 days a week. So you're getting more leverage on the infrastructure that you're built with if you're Robinhood. So all of these things are the company moving in the right direction. And I think Vlad's probably right that trading is eventually coming to 24 hours a day. I don't know how quickly that's going to happen. And it will be a matter of how much liquidity ends up in the market, and do the exchanges actually have to react as well. So we've seen this work in cryptocurrencies. The downside is you do have differences in liquidity over the weekends in crypto. You also have crazy moves at odd hours of the day. So that could definitely happen in stock markets if you're going to be trading for 24 hours a day. But I think this is probably bigger news than a lot of investors think. And just like $0 trading fees, this could be Robinhood again leading the way in disrupting the traditional brokerage business. But what do you think about Robinhood and Vlad's comments? Leave your comments in the comment section below. Don't forget to subscribe to Asymmetric Investing. Thanks for watching, everybody. See you here next time.